Good morning, good afternoon, good evening, wherever you are. I'm David Wu. Welcome to the Money Game, where we make actionable predictions about the big story shaping the world today, based on a rigorous analysis of facts and numbers. If you're interested in making money, you're in the right place. If you're not, please don't leave, because this program is for anyone who's interested in learning about what makes our world tick. Please subscribe if you find the program helpful. For those of you from Great Britain, a word of congratulations on the triumph of Emma Raducanu at the US Open yesterday, the first time a British woman winning a Grand Slam in 50 years. I don't know if it's just me, but my impression is that since Brexit, British athletes and sports teams have been doing a lot better, like winning the Cricket World Cup in 2019 and qualifying for the 2020 Euro Cup final. Maybe leaving the EU has helped revive the competitive spirit of Great Britain. Certainly, Britain after Brexit shows that a little bit of nationalism is not a bad thing. By the way, please do not let them cancel Winston Churchill. You know what I mean. Now let's get on with the program this week. Those of you who watched the program last week will probably remember that I recommended selling small cap stocks. Well, guess what? Small cap stocks were the worst performing asset this week. As you can see on this slide here, Russell 2000, which is the benchmark index for small cap stocks in the US, was down as much as 3% on the week. Now, it's true that the entire stock market fell back, but Russell did worse than others. It feels great to be right. However, the question is, what comes next? Should investors view the hiccup we saw last week as an opportunity to buy on dip, or that this is a harbinger of more correction to come? This is what I'm going to talk about next. My view is that the stock market remains vulnerable, at least over the next few weeks. This is why. Number one, my analysis of Biden's new COVID plan suggests it might do actually more damage than good. Number two, I think strong inflation readings around the world is transitioning the market away from the so-called bad news equals good news regime to a bad news equal bad news regime. Thirdly, I think September you will see an increase in policy uncertainty as a result of increase in political uncertainty as a couple of key countries hold their elections and Washington enters into another round of fiscal brinksmanship. Let's start with COVID. I know I've spent a lot of time talking about COVID the last few weeks, but in my humble opinion, without forming a view on COVID, it's almost impossible to form an informed view about anything else. That's how important COVID has become for basically this prediction game. There's a lot of new information every week about COVID and COVID vaccines. So what did we learn this week? Well, the CDC published a report in which it showed that Moderna vaccine is 95% effective at preventing hospitalization. Wow. However, the number for Pfizer is only 80%, and for Johnson & Johnson is only 60%. So one thing we learned this week is that most vaccines are less effective against Delta. This is important, especially given the fact that we also know that the effectiveness of vaccines wane over time. According to a recent UK study based on over 1 million people, the protection offered by Pfizer dropped from 88% at 1 month to just 74% after 5 or 6 months. And for AstraZeneca, the protection is even less, just after 4 to 5 months. The idea that vaccines' effectiveness wanes over time is borne out by macro-level data. I've been arguing for the last few weeks that it is not a coincidence that countries like Israel, UK, US, and Switzerland that are currently experiencing high level of infections relative to their population were also the first to start administering the vaccines 8-9 months ago. To the extent that the majority of their vaccinated population would have received their vaccines at least 4 or 5 months ago, it's reasonable to assume that their population is the first to start to see the effectiveness of the vaccines wearing off. I also been telling you that the race for the third booster shot was very much on. I also told you that in Israel, the government has taken a particularly activist approach at trying to basically administer the third booster shot to anybody who wants one. In fact, more than 3 million people have now received a third booster shot. And guess what? This aggressive approach is starting to pay off. As you can see on this slide here, the number of new cases in Israel has come off sharply just over the last 2 weeks, in contrast to the US and UK, where the numbers remain actually quite sticky. A new Israeli study shows that the third booster shot is not only effective, but very important. What they found is that for adults over the age of 60, 12 days after having received their third booster shot, the Pfizer, basically vaccine, they were about 11 times less likely to be infected with COVID, and moreover, about 10 times less likely to have severe illness compared to those who only received 2 doses. Okay. The third booster shot has been such a big success here in Israel that people are already talking about the need to prepare for the 4th booster. The UK is not moving as quickly as Israel, but at least this week, the UK medical regulator gave the final go-ahead to both AstraZeneca as well as Pfizer for their vaccine to be used for the third booster. What about in the US? You might remember last week I told you that there was a growing chance that the September 20 rollout of the third booster promised by Biden was going to get delayed. Guess what? The talk of the town this week was that Biden's September 20 rollout is going to get scaled back. The FDA, the Food and Drug Administration, which has not yet approved any third booster, is only going to sit down and to review the application from Pfizer on September 17th. It's almost impossible now that Moderna is going to be included in the September 20th rollout. And then for Johnson & Johnson vaccine, it could be still months away. And only once after the FDA has approved the drug, then the CDC advisory committee still has to basically determine who's going to get the shot. In any event, now I think it looks like it's going to be October at the earliest when we start to see a significant number of Americans starting to receive their third booster. While the Biden administration is dawdling on the third booster, it opened a new front against COVID this week. You might have heard, Biden decided to mandate all employers to require their employees to either get vaccinated or to undergo regular testing. He also mandates all federal employees to get vaccinated within the next 75 days or risk termination of employment. Well, what did this achieve? We saw massive, basically, outcry from the Republican-controlled states, with at least 19 governors coming out vowing to take Biden to court over this, basically, order. I'm a big believer that vaccines are the only way we're going to be able to live with COVID. But even I struggle to see what exactly Biden's new policy is going to be able to achieve. If you look at basically the numbers, the share of Americans having received at least one shot has gone up from 67% to 75% in the space of the last 6 weeks. So already the surge in infection is pressuring a lot of Americans to basically get vaccinated. Of the remaining 25% of Americans who are still not yet vaccinated, guess what? A recent poll suggests 7 out of 10 of these people said that they would quit their jobs if their employers should require them to get vaccinated without religious or medical exemptions. In other words, I think that the margin of return on Biden's policy is going to be very limited. I cannot help but think that Biden's new COVID war against the anti-vaxxers is calculated for personal gains. After all, his approval rating being below 50, he's probably desperately trying to show up support, at least among his traditional supporters. And then with 52% of Americans saying that they agree that business should require their employees to get vaccinated, Biden might think this is one way for him to crawl out of the hole. Biden's COVID math simply doesn't make any sense, at least not to me. He's focusing his energy on the 25% of Americans who remain unvaccinated, as opposed to 50% of the Americans who have been vaccinated, but guess what, who are now at risk of seeing the effectiveness of their vaccine wearing off. I don't understand why Biden is dragging his feet on the third booster. Okay. Meanwhile, rising breakthrough cases, in other words, infection among fully vaccinated people, is only helping to harden the stance of the anti-vaxxers by strengthening their skepticism. Okay. As I've been saying for a while now, politicization of COVID in the U.S. poses a huge risk to the U.S., especially to the U.S. economy. While the Biden administration dragged its feet over the third booster shot, the number of Americans, fully vaccinated Americans who are concerned about catching the virus has gone up to 52%, according to the latest Washington Post ABC poll. Okay, I suspect this is the reason why we saw a collapse in consumer confidence last month to the lowest level since the beginning of the COVID pandemic. That just tells you how big this problem is going to become for the economy. In my humble opinion, the decision to reopen the schools without putting the third booster program into effect is very dangerous, and I suspect that we could see COVID cases marching higher as we move into the colder months later this year. And I think that implies growing risk for the U.S. economy. As you can see on this slide here, already consensus forecast for the U.S. is coming down relative for other major economies. The stock market is having a great year. One of the reasons why it's been doing so well, especially of late, is because investors have decided bad news equals good news. In other words, even when economic data are bad, investors use that as an opportunity to buy more stocks. You might say, well, is the market mad? No, because the market believes that, central banks have no balls, that central banks hate bad news even more than the market. So when we get bad news, bad data, central banks will be under pressure to actually, lower interest rates, print more money to keep the market afloat. They believe that central banks, that never wants the stock market go down, is the reason why the market has come to believe that bad news equals good news. The problem with bad news equals good news logic is the fact that central banks hate inflation even more than they hate bad news. This week, we got more data suggesting that inflationary pressure remains alive and kicking. In the U.S., we got the latest producer price inflation data. Producer price is the price producers pay for goods and services. And you can see on this chart, it's going through the roof. It is now fast approaching 7%. What this means is that producers will either have to pass on higher costs to the consumers, or they'll have to take a hit on their own profit. Either case, it cannot be good for the stock market. This week also got the Chinese producer price inflation data. As you can see on this slide here, that at least in the manufacturing sector, producer price inflation is going through the moon. In fact, it is now running at the fastest pace in the last 20 years. To the extent China remains the workshop for the world, the fact that manufacturing price inflation is going through the roof in China, that does not bode well for the rest of the world. In Europe, producer price inflation is also surging, which no doubt contributed to the fact that core consumer inflation came in at 1.6% last month. We're going to have new CPI numbers out next week. I suspect that numbers will continue to confirm that inflationary pressure is building up, and this could help strengthen the inflation hawks at the European Central Bank. Indeed, even with the global economy slowing in the face of rising inflationary pressure, the Fed and the ECB, already under pressure to withdraw some stimulus last week, the European Central Bank unexpectedly announced that it would conduct its bond buying at a moderately lower pace. Okay. Moreover, over the last couple of weeks, the Federal Reserve officials have been hinting that they would announce, okay, at the September 21st, 22nd meeting, that they will begin tapering the so-called reducing bond purchases at the November meeting. Beijing is less concerned about consumer price inflation, but is much more concerned about asset price inflation, especially given the brisk pace of home price appreciation over the last year. This is the reason why Beijing has been engineering a slowdown in credit growth. As you can see in the numbers released this week, overall credit growth, captured here by total social financing, continues to slow to just barely above 10% now. With some of the developing countries such as Korea and Russia having already tightened monetary policy, it seems just a question of when before policy tightening becomes a global synchronized event. Against this backdrop, I think it's reasonable to assume that the best part of the so-called global recovery is probably now definitely behind us. As you can see on this slide here, okay, only 2 out of 10 countries among the 10 largest economies in the world actually saw an uptick in their manufacturing sector last month. That does not bode well for the global recovery. You might say, what does any of this have to do with what I was talking about earlier, that bad news have become good news for the market over the last 3 months? Well, let me explain to you how. Okay. On this slide here, I plotted in orange the number of weeks during which this year that we saw the stock market going up while the bond yields went down. I called that bad news equal good news weeks, because usually bond yields go down when you get bad news. But if the stock market went up at the same time, that's probably indication that, the prospect of easier monetary policy has basically offset the bad news for the stock market. In blue, I plotted what I call bad news equals bad news regime. And here is when we have the stock market going down while the bond yields are going up in a week. Okay. What is interesting, of course, is that, last week was the first time in a very long time we saw indeed that the stock market going down, but bond yields going up. To me, that suggests that investors starting to realize that basically rising inflationary pressure is leaving central banks with very limited room to maneuver, that their ability to come and rescue the stock market is going to become increasingly limited as they have to focus on their inflation fighting credential. I think this is going to be a big problem for the stock market going forward. Now let me turn to politics. In my humble opinion, I think September has got some surprises on the political front for the stock market that the stock market won't like. Canada will be holding its federal election on September 20th. 3 weeks ago, Prime Minister Trudeau called the snap election. 3 weeks ago, frankly speaking, nobody really cared about this election because it looked like it was going to be a walk in the park for Trudeau. Because at the time, the number of COVID cases were going down, and Trudeau's approval rating was riding high. But guess what? 3 weeks later, COVID cases are soaring. In fact, they have more than doubled since the day he called the election, and his approval rating has been sinking. And the opposition parties accusing him for holding the election for personal gains at a time the country is struggling with COVID. All of a sudden, this election has become a lot more important precisely because the outcome has become much less predictable. The election right now is too close to call. With the Conservative Party and Trudeau's Liberal Party tie at 30% apiece in the opinion poll, it looks like the most likely outcome is going to be another minority government. In other words, gridlock. However, there is the possibility that somehow Trudeau and the New Democrats manage to get enough votes to basically have a combined majority in the parliament that will allow them to basically rule, together in some capacity. But this will definitely force Trudeau to move further to the left in terms of agenda. The New Democratic Party wants to basically spend 200 billion basically Canadian dollars to be financed by tax hikes on the rich and by businesses. So my view is that either we're going to get crippling gridlock in this election, or we're going to see a swing to the left in Canadian politics after this election. Germany will be holding its own federal elections on September 26th. The latest poll basically showed that the CDU, the Christian Democratic Union, continues to struggle to recover their lost momentum. Okay. The SPD, the Social Democratic Party, remains in first place, followed by the CDU, and with the Greens in third place with about 17%. Increasingly, it looks like, whoever is going to be forming the next government, the Greens is going to be part of the government. They're going to be the kingmaker. And that's where the political uncertainty comes in. Much like the New Democrats in Canada, the Greens also want to pass big spending programs financed by new taxes on rich people and on businesses. In other words, the most likely outcome of the German election is either another grand coalition involving the SPD and the CDU, or basically a swing to the left as the price basically any government will have to pay to bring the Greens into the government as their coalition partners. The biggest unpleasant surprise in store for the market in September will come from the US, in Washington, where the shit is about to hit the fan. The reason for this is very simple. There are three tricky deadlines. Number one, unless Congress raises the debt ceiling, the US will have no choice but to default on its debt obligation sometime between October and November. The second deadline, unless Congress can pass at least a stopgap budget, basically by the end of September, the US federal government will shut down on October 1st. Third deadline, the Democrats in the House have imposed a deadline to vote on the infrastructure bill on September 27th. It is going to be difficult for them to meet all these three deadlines at the same time. The reasons are complicated. It's more than what I can cover in the next few minutes. But the essential problem lies in the fact that the House Democrats, led by Pelosi, have made it very clear that they're not going to vote on the infrastructure bill unless the Senate has basically voted on the $3.5 trillion social spending package that they want so much. The problem with that is that many, some, even just one moderate Democrat thinks that number is too big, 3.5 trillion. This could potentially upset the entire apple cart. Again, this is an issue I plan to delve into at greater length next week when we're closer to the action. But let me tell you, this issue is not going to be resolved easily. And I think from that point of view, you're going to see a lot of fireworks out of Washington in the next few weeks that could potentially scare the shit out of the market. So what is my bottom line? I think the conclusion is to remain defensive. I think stocks remain vulnerable after last week's sell-off. I think bonds will offer portfolio protection only if, you have an extreme sell-off in the stock market, which means for now, cash is king. And there's also no doubt the dollar most likely will basically benefit from increased volatility that generally favors dollars safe haven status. Now, what is the risk to my view? In the short term, I would argue that the biggest risk to my view is if the Reddit, day trader decided to prove me wrong. These people, at least according to our sentiment index, remain super bullish about the market. They've been buying on every dip. These guys just been there driving up the market every single day. If they decide to once again defy logic, you know what? I cannot basically rule out the possibility that they just basically push the market even higher and basically delaying the day of reckoning. Okay. This is also the reason why I fully expect to see some buy on the dip rally maybe on Monday, Tuesday next week, but I think that might provide a better level and opportunity to sell into it. That's it for this week. Talk to you next week.